Asian markets were trading in a mixed manner on Monday as investors awaited a fresh round of U.S.-China trade negotiations expected to begin later this week. Investors were somehow nervous amid the reports that Chinese officials are growing hesitant to pursue a broad trade deal with the U.S. Market participants are cautious as they realize that the outcome from this week's dialogue could be pivotal in determining if the two countries manage to strike an interim trade deal. Markets in Asia had a rather muted reaction to the U.S. non-farm payrolls data released last Friday. Unemployment rate unexpectedly dipped to a fresh 50-year low in September, while the non-farm payrolls rose by 136,000, below the 145,000 jobs expected. Market expectation for a rate cut by the Fed at its upcoming October meeting was last at about 80%. The odds of a rate cut rose after last week's disappointing U.S. manufacturing data, which showed a contraction in the sector. The MSCI Asia ex-Japan index rose 0.16% on Monday. Japan's Nikkei 225 finished 0.16% lower at 21,375.25. South Korea's Kospi closed fractionally higher at 2,021.73. In Australia, the S&P ASX 200 advanced 0.71% as parts of the country were closed for the Labor Day holiday. Markets in Hong Kong and China were closed for the holidays. In Europe, stocks climbed on Monday as investors looked to hints from the Brexit front and U.S.-China trade talks. Stocks were also buoyed by a positive jobs report out of the U.S., which partially eased recession concerns. Meanwhile, British Prime Minister Boris Johnson urged French President Emmanuel Macron to push forward to secure a Brexit deal. He also reiterated his intention for the UK to leave the EU on October 31st. The EU will decide at the end of this week whether a deal is going to be possible. On the data front, German industrial orders for August fell by more than expected, reinforcing fears that the Eurozone's largest economy is going toward recession. Eurozone Centix investor investment fell to negative 16.8 in October from negative 11.1 in September, hitting its lowest since April 2013. Wall Street stocks finished lower on Monday following a choppy session ahead of U.S.-China trade talks, minutes from the last month's Federal Reserve meeting, and key data on consumer prices. Investors are also preparing for a third-quarter earnings session, which begins this week. The Dow Jones Industrial Average dropped 0.4% to 26,477.75. The broad-based S&P 500 fell 0.5% to 2,938.74, while the Nasdaq Composite Index shed 0.3%, closing at 7,956.29. In currencies, the U.S. dollar index rebounded towards 99 during the American session amid late reports that China is preparing to make a partial trade deal with the United States. The euro-U.S. dollar failed to get back above the 1.10 handle and turned negative on the day. After touching a daily low around 1.0960, the pair trimmed intraday losses to just 1.0970 and remained on the defensive. The report showed that the manufacturing sales in Germany continued to decline in August and added to the negative sentiment around the common currency, with further ECB easing may weigh in on the euro. In commodities, Brent crude was rising relatively steadily earlier in the day, but faced offers around $59.60. The futures were rejected from daily highs and closed at $58.40, marginally higher on the day. The dynamics shows that traders are hesitating ahead of a new round of U.S.-China trade talks and prefer to sell Brent on bullish attempts. The futures will likely try to gain in the days to come, but sell-on-rally strategy will persist until the outcome of trade talks is found out. On the other hand, the market was buoyed earlier in the day amid deadly anti-government unrest in Iraq, the second largest producer among the Organization of Petroleum Exporting Countries. Meanwhile, Libya's National Oil Corporation said that it would close the Fareg oil field at the Tuitena port for scheduled maintenance on Monday until October 14th. However, these drivers did little to give Brent a substantial support. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.